Hello, everyone, and welcome to today's session. I'm excited to kick things off with Chapter 2, Introduction to Securities Market, Mock Questions. In this presentation, we'll explore the basics of the securities market and prepare you with some useful practice questions. We'll cover key concepts and help you get ready for your exams. Let's get started. Today, we're focusing on the key regulators of the securities market in India. As you can see on the slide, there are several important authorities: RBI, SEBI, IRDAI, and AMFI. But the main question here is, which one primarily oversees the securities market? The correct answer is B, SEBI. SEBI, or the Securities and Exchange Board of India, is the primary regulator responsible for the securities markets. Its role is crucial because it ensures that the market operates in a fair, transparent, and efficient manner. While RBI, the Reserve Bank of India, mainly regulates banking and monetary policy, and IRDAI oversees insurance, and AMFI is associated with mutual funds, it's SEBI that takes the lead when it comes to securities. Understanding this helps us grasp how different financial sectors are regulated and how SEBI's role ensures investor protection and market integrity. So, whenever we talk about securities regulation in India, SEBI is the key authority we focus on. Now, let's focus on the primary market, which is all about the new issue of securities by companies. This is where companies raise fresh capital by issuing new shares or bonds directly to investors. When a company goes public through an IPO, or when it issues additional shares via FPO or rights issue, these transactions happen in the primary market. It's essentially the first sale of securities, and the proceeds go straight to the company. This is a vital part of the overall securities market because it helps companies fund their growth and expansion. So, to sum it up, the primary market deals specifically with the initial issuance of securities, newly created financial instruments that investors can buy directly from the issuer. When we talk about the secondary market, the key idea is that securities are traded between investors themselves. So, the correct answer here is B. This means that once securities are issued in the primary market, they move into the secondary market where investors buy and sell among each other, typically on stock exchanges. This trading process is crucial because it provides liquidity, allowing investors to sell their securities whenever they want. It's different from transactions directly between a company and investors, which happens in the primary market. So remember, in the secondary market, securities are traded among investors ***. Now let's look at some of the key players involved in the Indian securities market. On this slide, you'll see 4 options: A. NSDL, B. BSE, C. NSE, and D. RBI. The question here is, which of these is a depository in India? The correct answer is A. NSDL. NSDL, which stands for National Securities Depository Limited, along with CDSL, are the 2 main depositories in India. Their primary role is to hold securities like shares and bonds in electronic form, making the entire trading process safer and more efficient. It's important to understand that depositories are different from stock exchanges like BSE and NSE, which facilitate trading. The Reserve Bank of India, or RBI, is the central bank and doesn't function as a depository. So, when we talk about depositories, we're referring to institutions like NSDL that provide the infrastructure for the electronic holding and transfer of securities, helping to streamline and secure the entire investment process. Now, let's look at some key concepts related to modern securities management. First, we have rematerialization, which involves converting electronic holdings back into physical certificates. Then there's dematerialization, and that's where our focus is today. Dematerialization refers to the process of converting physical share certificates into electronic holdings. This shift is significant because it simplifies transactions, reduces the risk of loss or theft, and makes trading much more efficient. Moving from physical to electronic records helps streamline operations across the entire market. Next, we have digitization, which encompasses broader efforts to convert various forms of data into digital formats. not just securities. And finally, reconciliation involves ensuring that records across different systems match, maintaining data accuracy and integrity. But for today, when I ask about converting physical share certificates into electronic form, the correct answer is dematerialization. This process is a cornerstone of modern financial markets, making trading faster, safer, and more transparent. Now, let's take a look at the settlement cycles. The correct answer here is A, T+1. This means that India has moved to a T+1 rolling settlement cycle for equities, which is a significant step forward. It indicates that trades are now settled one business day after the trade date. This shift not only speeds up the settlement process, but also reduces the counterparty risk. To give you some context, previously, many markets operated on a T+2 cycle, meaning 2 days after the trade date. Moving to T+1 aligns India with some of the most advanced markets globally and helps improve overall market efficiency. Understanding this change is crucial because it impacts how quickly investors can expect their trades to settle and how the entire trading ecosystem operates more smoothly. This transition to T+1 reflects India's commitment to modernizing its financial infrastructure and enhancing investor confidence. When we look at different types of financial instruments, it's important to understand their characteristics and how they fit into the broader financial market. On this slide, we see 4 options: equity shares, treasury bills, corporate bonds, and equity derivatives. Now, focusing on the key question, which of these instruments is traded in the money market? The correct answer is B, treasury bills. Money market instruments are primarily short-term, meaning they have maturities of less than 1 year. They are used by governments and corporations to manage their short-term funding needs. Treasury bills, or T-bills, are a prime example because they are issued by the government and typically mature within a few months. In contrast, equity shares or stocks are long-term investments. Corporate bonds usually have a longer maturity period, and equity derivatives are complex instruments that can be used for hedging or speculation, often involving longer time frames. Understanding this distinction helps us grasp how the money market functions as a vital component in maintaining liquidity and providing short-term financing options in the financial system. Now, let's look at some of the core functions of stock exchanges. First, providing liquidity. This means ensuring there are enough buyers and sellers so that trading can happen smoothly. Without liquidity, it would be difficult to buy or sell securities at fair prices. Next, we have price discovery. This is a crucial role because the exchange helps determine the fair market value of securities through the ongoing process of matching buy and sell orders. It reflects the collective information and sentiment of all market participants. Then, there's clearing and settlement. This process ensures that once a trade is made, the transfer of securities and funds happens accurately and efficiently, reducing the risk of default. Lastly, printing share certificates. While this might sound like a straightforward task, it's actually not part of what modern exchanges do. In fact, exchanges do not print physical certificates anymore. These are handled electronically by depositories. So, the correct answer here is D, printing share certificates, because it's not a function of stock exchanges today. All right, let's talk about the benchmark indices of the Bombay Stock Exchange. When we refer to the BSE's primary indicator, it's known as the Sensex. This index is composed of 30 major companies across various sectors, which makes it a reliable snapshot of the overall market performance. It's often used by investors to gauge the health of the economy and market sentiment. Remember, the Sensex is a key benchmark that reflects how well the stock market is doing. In comparison, there are other indices like the Nifty 50, which we'll cover later. But for now, keep in mind that the Sensex is BSE's 30 stock benchmark index, representing the top players in the market. Let's look at how market capitalization is calculated. The correct answer here is option C. What that means is, market cap is found by multiplying the total number of shares outstanding by the current market price per share. This is a key measure of a company's total value in the market. Now, to clarify the other options briefly. Option A, multiplying the number of shares sold by the market price, isn't correct because it only considers shares recently sold, not the total outstanding. Option B, multiplying face value by the number of shares issued, relates more to the company's accounting value, not market cap. And option D, profit after tax times the PE ratio, gives you the company's market price or valuation indirectly, but it's not the direct calculation for market cap. So the main takeaway here is that market capitalization equals the number of shares outstanding multiplied by the current market price. This helps us understand the company's size and market value at a glance, which is fundamental in analyzing any publicly traded company. Now, let's take a closer look at the options for issuing new shares. Option A suggests shares are offered only to the public, which is a common method, but not specifically a rights issue. Option C involves shares allotted to employees, which typically relates to employee stock options or incentives, not rights issues. Option D refers to shares allotted solely to promoters, which isn't how rights issues are structured either. The correct answer here is B, shares offered to existing shareholders. This is what we call a rights issue, where companies give current shareholders the opportunity to buy additional shares in proportion to what they already own. It's a way to raise capital while rewarding and involving existing investors. So the key point is that rights issues are targeted at existing shareholders, allowing them to maintain their ownership percentage if they choose to participate. This concept ties into our overall discussion on different methods companies use to raise funds and how they engage with their investors. All right, let's talk about the approval process for public issues of securities in India. When a company wants to raise funds by issuing shares or other securities to the public, they need to get the necessary approvals before they can go ahead. Now, among the options, RBI, Ministry of Finance, SEBI, and IRDAI. The key player here is SEBI. That's the Securities and Exchange Board of India. SEBI is the regulatory authority that oversees the securities market, ensuring transparency and protecting investors. So, practically speaking, all public issues of securities must get SEBI's approval before they can be launched. This process helps ensure that the company meets all regulatory requirements and provides accurate information to potential investors. Remember, this approval process is a crucial part of maintaining market integrity and investor confidence, and it ties into our overall theme of understanding the regulatory landscape that governs financial markets in India. So, whenever you hear about a company going public, keep in mind that SEBI has to give the green light first. Let's talk about the primary market, which is where the initial listing of a company happens. When a company decides to go public, it issues shares for the first time to the public in this market segment. This process is called listing, and it's a crucial step because it allows the company to raise capital from investors. The primary market is essentially the launchpad for new securities, and it's different from other markets like derivatives, commodities, or currency markets. Understanding this helps us see how companies connect with investors initially, setting the stage for their growth and development in the financial world. The correct answer here is B, the highest price a buyer is willing to pay. Now, let's break that down a bit. When we talk about the bid price, we're referring to the maximum amount a buyer is prepared to offer for an asset. It's essentially the buyer's ceiling, their top price. This is a key concept because it helps us understand market dynamics. Buyers are signaling how much they're willing to spend. And remember, in contrast, the ask price is what the seller is asking for. It's their minimum acceptable price. Together, bid and ask prices form the foundation of trading activity, showing us the supply and demand at any given moment. So, when we talk about the bid price, think of it as the highest price a buyer is willing to pay, which influences where the market trades and how prices move.